Welcome to the Using BRRRR for Infinite Cash Flow Returns mini lesson. This is a real estate transaction planning strategy that we really like at Teaching Tax Flow. It works very well for our goal diagnosis taxpayers, meaning tax-free income and growth. It also works well for our RED because using this strategy, you're able to increase your rental portfolio, increase your cash flows without triggering any negative tax consequences. So let's dive in and we're going to hit the agenda next. Talked a little bit about BRRRR from a 30,000 foot view and what BRRRR stands for. It's an acronym that's very popular in the real estate investing world. It stands for buy. So you buy a property. It doesn't have to be residential. It could be really several different asset types. Rehab or renovate, rent, refinance, repeat. And with the BRRRR method, what you're trying to do is you're trying to recover as much money as you can from your cash outlay from buying that property. We're going to look at a case study, looking at different types of assumptions and really driving home that cash flow versus tax flow. So remember, one of the three laws of teaching tax flow, cash flow does not equal tax flow. And the second of three laws is that tax agencies are your involuntary business partner. So what we're trying to do is we're trying to increase that rental portfolio without paying your involuntary business partner any tax and creating positive tax-free or very low taxed tax flow. Then we're going to hit our calls to action. So let's jump into our real estate transaction planning chart, the chart we use in many of our mini lessons, much of our content. And when we're talking about the BRRRR method, we're really focused here on the right-hand side on an investment property. So it really does not work with a primary residence, but with an investment property. And you can see right here, instead of selling the property, we're actually renting that property and hopefully BRRRRing it and maybe getting as much equity as we can out of it if you want to increase that rental portfolio. You can see that it's not currently taxable when you use this method. And so that's why it's so attractive with many real estate investors. Now, that's the theory of it. Let's dive into a case study. And with any case study, I'm going to run through some assumptions. Now, the assumptions are always a moving target, and assumptions are going to be different from market to market. But based on national averages and what we see in 20 years of experience working with real estate investors on the tax planning and strategy and preparation side, here are the assumptions that we're going to use. One, we're at a 30-year mortgage at 6% interest rate. We're going to assume the renovations to the property are not financed. Some people can and do finance those renovations, but again, that's just what we're going to assume right now. Obviously, this is a non-primary residence. We're working right through these assumptions here. Monthly expenses can vary based on locality, but we're looking at 12% for maintenance and vacancy, insurance, property tax. Again, those are all very locally driven. Now, the key to BRRRR method is once you acquire the property, we're going to walk through that process, and you renovate it, you need to figure out what the appraised value and after repair value is. So after repair value, the acronym ARV, all right? And typically, we're going to be able to pull out 75% of the equity, 75% of that after repair value or appraised value when doing that BRRRR method. So that's what we're really targeting. That refinance is 75% of the appraised value. We really want that after repair value to be at least the amount of the appraised value. Finally, we're assuming the annual federal tax of 22%. So let's dive into this case study. 123 Burr Street. This is a property that you'd buy for $120,000, and you can see each step of the process right here. So purchase price $125,000, renovation to $20,000. So your cost basis, so your cash flow, your tax flow versus cash flow, your cash outlay at this point is $145,000. All right, we're going to talk about the financing part of that. Now you got to determine what's your rent amount going to be. Well, if your monthly rent's going to be $1,550, monthly expenses and mortgage payment based on the assumptions that we have, that means your net cash flow is going to be $305 per month. So buy, you get it renovated, you get it rented, and then you refinance. We're shooting in this case for an ARV and appraised value of $193,300. The reason, 75% of that is going to get you to your refinance amount of $144,975, which is as close as we can get to our cost basis. So in this case, you'd be out of pocket a whopping $25. So when we're talking about infinite cash returns, that's what we're talking about. You're out of pocket $25. You're bringing in $305 per month. and then you repeat. Fair market value, $193,000. You have a mortgage on $144,975, and you have a nice amount of equity in the property, and you go forward with that $25 outlay. Obviously, when we're talking about rental properties, we need to make sure that the property makes sense from a rental perspective. So we're going to look at that 1% rule that many people are familiar with. 1% of the taking your monthly rent and dividing that into the tax cost basis. And we're looking at tax flow versus cash flow. Your total tax per year is going to be $39 approximately. Your taxable income is going to be about $177 compared to the actual cash flow of $36.60. So you're getting $36.60 per year. You're only paying tax on $177. This is an amazing BRRRR worksheet, and you can apply these type of principles to any property that you have. Let's tie a bow on this. Call to action. Take a look at the BRRRR method and determine if it fits your goals and time horizons. Are you a red or are you a gold diagnosis? Are you trying to grow your rental portfolio? Calculate your potential property acquisition, that tax flow versus cash flow. We always talk about using the BRRRR method. Make sure that you're going to be able to hit those ARV and appraised value numbers before you even go into the project. And make sure you have a solid, we teach this in Teaching Tax Flow 101, the board of directors. You're going to need help with lending partners, a CPA or tax professional, insurance partners. So make sure that board of directors is built out so you can implement BRRRR properly. All right, thanks for watching. Have a great day.
John here from Teaching Tax Flow. I wanted to thank you for watching this video. We literally have hundreds of hours of content between podcasts, webinars, videos just like this built specifically for you, the taxpayer. Whether you're a full-time employee, you're a freelancer, you're a contractor in some other sense, or you're thinking about getting into business for yourself. Everything here at Teaching Tax Flow is perfect for you, basically going off of the roadmap provided by the IRS to legally and ethically reduce the taxes paid over your lifetime. So be sure to subscribe to this channel and connect with Teaching Tax Flow, and we will see everybody very soon.